So today's Cardinal Lesson, we're introducing a new annuity hybrid annuity long-term care policy. And I know that's a mouthful. And as with most annuities, it has an easier health qualification. So I say, why are you showing us an annuity? Because typically these hybrid policies that pay for long-term care are life insurance policies. And they have a more strict underwriting qualification just because they are life insurance. They're going to pay off some additional money beyond the money you put into it at your passing. And by going to an annuity, we get several benefits. We keep some of the same tax benefits. So, and the real highlight of this thing is the underwriting and the health questions. I'd say the highlight is the qualifier. And there's a whole bunch of people that can get this that couldn't get the life insurance long-term care policy. So I want to put it to Tom, and I want Tom to share with you why we're doing this video today. Why is this so important?
Yeah, I mean, we're doing this video because of everything that we work with, all of the stuff that we help plan around. Long-term care is the most impactful. Right? If you end up needing this, or your loved one ends up needing this, it will upend your whole life. And so, if you've ever thought, you couldn't qualify for long-term care due to your health, this product could be for you. Right? I mean, personally, I couldn't qualify for most products. Right? If you've watched the show, you know I have an autoimmune disease. We have others shows where we go more in detail there. I couldn't qualify for most. I'm not old enough yet, but I could qualify for this one. So if you're in that camp, I want you to really pay attention, or if you know somebody who's there, this could be a good option for them. And so let me bring up the show notes here. You can find these at the link below our video. They're also on our website at cardinalguide.com. We have the board. Again, if you want to print it out and look at it a little more closely, because we do have a lot on this board today. So it might be helpful to do that. And then we have sort of a PDF version of the stuff that's on the board there. And then there's this illustration. We're going to go over all the important numbers when we're walking through the board here. But if you want a little bit more details, go in, take a look at this, just to so you're aware. This particular illustration was run for a male 65-year-old here in North Carolina. This policy is in most states. So again, call us if you don't meet that exact thing, which you probably don't. We can see if it makes sense for you. So let me turn it back to Hans. Let's go over some more of the sort of details of the policy here.
Okay, so why are we going to use an annuity as the chassis or the insurance policy to get long-term care insurance? And really a couple of reasons versus using life insurance. A couple of reasons. One is the qualification and the underwriting is easier. But the second reason is you already have money in an annuity out there. Maybe you're in your 70s and you bought this thing a few years ago and it's just sitting there accumulating. Maybe it's not even performing as well as you wished, but it's just money sitting there. But you've got some pent-up tax-free or tax-deferred dollars inside of that, and you're just kind of leaving it alone. You don't really have a purpose for it. We can take that annuity and we can do a 1035 exchange, and we can move it from where it is into this policy and get you some pretty substantial long-term care benefits. So that's another reason to use an annuity, is to take money from an annuity, roll it into a new annuity that has long-term care insurance benefits. So before we get into the details of this, I also just want to impress upon people that what Tom was saying is if you're one of these folks who have just dismissed long-term care and you've just said, look, I'll pay for it myself. It's too much money. I don't want to go through that. You start quoting stories of stuff that happened to your parents or your aunts and uncles or things you've read on the internet. You know, most of that stuff is true. There's certainly a lot of bad examples of long-term care. But Tom and I are financial planners. And, you know, I've been doing this stuff for 50 years. I've been in the Medicare business. I've been in the long-term care business for 40 years. So I've lived through all of that. And what I say to industry people when I'm talking to them is, so after all this stuff settles and all this bad stuff that's gone on around long-term care, what do you do for your clients now? And boy, I get silence for a lot of people they're spouting the same things. It's too much money and too hard to get, and insurance companies that they're going to be hard to pay off. Okay, that's great. We got all that. What do you do for your clients right now? And A lot of them don't have a good answer. And what my answer to that is I'm going to impress upon my clients the need to do some planning so that if this horrible event happens to you and your family in the future, we at least have the money taken care of. And so if this isn't the right product for you, possibly there's some other. So I really would like you to pay some extra attention today in the general sense that this is one choice of many. So what I want to jump into is what we're featuring here is we're showing a 65-year-old male, and I compared the two illustrations for the 65-year-old female. There isn't a lot of difference. So it's fine to just have one set of numbers. And if a person was going to use this for long-term care immediately, which is highly unlikely, they would have $4,166 a month of benefits, and that 4,166 would last for about 6 years. Now, or a $300,000 maximum of benefits. So you've taken $100,000 and turned it into $300,000 of long-term care benefit. It's pretty cool. Now, when you look down the road, as this thing is going to be credited, your annuity is going to be credited with 3% interest, guaranteed, and for the life of the policy. So there's going to be no fluctuation in any of that, up or down. And then deducted from that interest is going to be a long-term care insurance premium, essentially of $250 a year on 100,000, or $500 a year when you're up there in your 80s. So that every year there's a small premium or a small reduction in that 3% to pay for the long-term care insurance piece of this. It's relatively small. Like I said, you can look at the illustration, or you can have us prepare an exact one for you, and then you can decipher the effect of that. But so why are we doing this? We're putting $100,000 in there so that when we get into our 80s and we start needing long-term care, we're going to have $7,300 a month of benefit paid out, and a maximum benefit of $530,000. That's the effect of that 3% interest just compounding for long-term care. Now, I don't think 100,000 is enough. I mean, it's certainly going to be a good benefit, and for somebody that doesn't have any coverage, this would be a great start. To really get a full-blown long-term care policy that I would recommend, if I have some room in the budget, I would suggest $150,000, maybe $200,000 that you would put in here to get a really beefed up plan that's going to reimburse you for the benefits. Now, what's important to learn about this is this policy is a cash indemnity. So that's different than a reimbursement. So if we're, just so we understand it, if we need care, and let's say we are 85 years old and we've grown to this $73.55 a month benefit, you qualify for care, you meet 2 of the 6 activities of daily living you can't do without human assistance, and the doctor certifies that. You don't have to send in receipts to the insurance company. You just simply show them the plan of care, prove to them that you need the care. They're going to send you a check for this every month. Tax deductible check. You spend it as you see fit. You could hire somebody in your family. You could hire it privately. You could pay the bill at an assisted living. And like I said, this probably isn't going to be enough 20 years from now. That's why I'd suggest you put in more. But we're doing this just so you could sit down with a calculator and make some estimates. So I want to put it to Tom, and I want Tom to react to everything that I've just shared with you.
Yeah, I mean, what's really nice about this type of policy is, right, I mean, in the illustration, you can see those monthly benefits growing over the time, over however long you hold it, right? So if you're older, likely when you need the care, it's going to be a much higher benefit than it is day one. And then again, a big benefit is if you don't need care, which is the goal of all of us, right? I hope no one ever needs care. Now, realistically, we know that's not going to be the case. There's going to be a large percentage of you watching that at some point will need some level of care. But if you don't, or if you need a minimal amount, there's still this death benefit that gets paid to your beneficiaries is a death benefit. So I think all of those things are really helpful. And again, with all the guarantees built into this policy, you know what you have from day one. You don't have to rely on sort of what ifs or unknowns in terms of market performance, timing of when you might need care or markets down, or really anything like that. And then again, the indemnity benefit is really sweet that you get this check. You don't have to provide the receipts for the care, and it gives you some flexibility of how you spend that money when the time for a claim comes. So there's a lot of sort of flexibility with this policy, a lot of things that it benefits for. One of the things, and Hans mentioned this isn't the only policy, right? We have a slew of them that we can go look at depending on sort of what your particular situation is. Maybe it's a health concern, maybe it's a benefit thing we're looking at. So even if we're about to go through the health questions they ask, even if you fall within any of those, that doesn't mean you're precluded from all options. It would just be, this one might not be the right option for you. So again, we want to show you this because it is unique. It's new to the market. I think it does fit a gap that's been missing in terms of what's available. And so I would just, again, if you've ever questioned if you could qualify, I think this is something to really, really pay attention to.
Okay, so why are all these health conditions on the board? I'm going to talk to you about that. Is that this is going to have what we call easier underwriting or health questions to qualify. And this is pretty much all they're going to do is what's going down the right side of the board. And then let's not worry about this for a second. And what I'm going to add about all these health conditions, if you checked yes to any of this with the life long-term care hybrids or a traditional long-term care policy, you're not eligible for any of those, okay? And you're not eligible for this either if you check a yes over on the stuff down the right side of the board. Now, as Thomas just said, we went through this list together yesterday, Tom and I did, and we found several of these where we can actually get you on another annuity. So don't let this just knock you out of calling us. And we still want to plan long-term care. As if you're just ineligible for anything, we still want to help you and do some financial planning so that if you get in the situation of long-term care, because you have these health conditions, we want to help you and your family out so that you'll be ready for it financially. So let's go through what they are. So if right now you're in the hospital, you're confined to bed, you're in an assisted living, you're receiving home health care, adult daycare, or a nursing home, you're in a nursing home, you're not eligible. If within the last 5 years, you've used a walker, a wheelchair, a multi-prong cane, a hospital bed, a motorized scooter, a hospice, dialysis, stair lift. So within a 5-year period, if you use that substantially, you're not eligible. If you require assistance with any of these items, medications, dressing, getting dressed, eating, getting in or out of bed, walking, bathing, using the restroom, if you need assistance right now, you're not eligible. If we go 5 years back, if you have MS, Parkinson's, memory loss, dementia, Alzheimer's, muscular dystrophy, COPD, ALS, cirrhosis of the liver, Huntington's, back surgery with ongoing pain, narcotic pain meds, or surgery not done. So the good news here is if you can check no to everything, you can pass go. You're most likely eligible to get this policy. If you checked yes to something, I just want to tell you that we got other options for you. So, but we're talking about this policy today. So these are the things that are going to prevent you from applying. Now, what all of these questions are is once you've answered all of these no, we're going to go through this, and if you can check 2 boxes or less of these things right here, most likely you're going to qualify for the 3 times benefit. If you check 4 boxes, most likely you're going to get turned down for this policy. If you check 3 boxes, most likely you're going to get 2 times the benefit. So you're going to get a smaller benefit than what we have up here. But This is their whole underwriting game. So what we're talking about is aneurysm, heart disease, head injury, peripheral vascular, peripheral neuropathy, diabetes, stroke or TIA, multiple falls, balance disorder, tremors, blood clotting, organ transplant, except for cornea, rheumatoid arthritis with joint replacement, um, arthritis with narcotic pain meds, and bipolar or schizophrenia. So if you check, like I said, 2 boxes or less, you're still eligible for the full benefit, most likely. Um, if you check 4 boxes, then you're probably not eligible for this policy. If you check 3 boxes, you're going to get the smaller benefit. And again, I want to repeat, if you've gone through this simple exercise, we're going to do it again with you if you're interested in this thing. But if you've checked too many boxes and you're still interested in getting coverage, we've got other options for you where we might be able to get you covered. So I want to push it to Tom. I want Tom's reaction to all that.
Yeah, I mean, I think when you start looking through these questions, I mean, most of these is pretty serious stuff that a lot of other companies would just turn you down, right? And we probably, if you had some of these things, we probably wouldn't even apply. And there's some we would. So again, there's other companies that sort of compete with this, but there's plenty that would just say no. And so having another product, something available for people who have maybe had some health issues like I have, right? I mean, I have an autoimmune disease. Again, I've been through some really sort of serious things. Luckily, I'm fine now or stable. Most companies would look at me and say, "No, there's no way we want to take you." But I could qualify for this, and so I think it's. I'm glad we have it. I think it's very unique. I think it's a good option for people that maybe don't have the other things available. And again, it's having the indemnity benefit, having the death benefit there if you don't need it. There's just a lot of reasons that I think this makes a lot of sense for people. So I would really encourage you to consider this if you haven't looked at long-term care in the past.
Okay. So we're back on the policy. This cash indemnity thing where, a person puts $200,000 in here, which is the amount that I'd recommend if you're wanting to get a really substantial policy. That's $8,000 a month. And by the time you are 85, if you were 65, it's going to be almost $15,000 a month that you're collecting in 4 6 years is how long it's going to pay out. It's going to be a very good investment of the $200,000. My thinking is to collect that as a cash indemnity into the future is a pretty strong thing because you're going to receive the money. Most of it, if not all of it, is going to be tax-free, and you're going to be able to spend it on your own care as your family is going to be able to spend it on your care as they see fit. That cash indemnity is a very nice feature. It is going to be tax-free. We talked about 1035 exchanges. So if you have annuity money sitting there where you've put it there and maybe you're not really happy with it or it's just not doing much for you other than just growing tax deferred, you could take it and roll it over into this thing. This is available ages 40 to 80. So, and that's 80 and 364 days. So it's going to go quite high. The benefits are a bit different if somebody's in their late 70s that's applying, but they're still substantial. And there's 100% long-term care benefits are paid internationally. This is important to some clients where they anticipate that they're going to go back where they're from. They're living in the US now, and they're anticipating that they're going to get care. They're going to go back to some foreign country. This thing has no restrictions on the payouts of the benefits. Could be another reason for going for this. Tom?
Yeah, I mean, I think this lays out a lot of sort of the benefits and features of the policy. Again, one of the on the tax-free portion of it, I think that's an important thing to think about a little bit. Is these benefits coming out of the policy are not taxable. Whereas if you invested the money in, say, an account like in a brokerage account or something, when you go to sell something to pay for care, you're going to have, if it's coming out of a taxable account, it's going to be capital gains taxes. If it's out of an IRA, it's ordinary income tax. Whereas this would all be tax-free, and that's also helpful when Hans mentioned that 1035 exchange. So if you bought an annuity, and again, this would be with not IRA money. This is what they would consider non-qualified money. So money that's already been taxed. So you purchased an annuity back in the day with some of that money, you could transfer it over into this. That's not a taxable event. So you've moved it over here. There's built up gains in that policy, the previous one. Then you put them here. If it's used to pay for care, that money was never taxed. Whereas if you left it in the old policy and then you started pulling money out, you'd have to pay taxes on the gains at that point. So it is a way, if you have some accounts that you haven't used that have some built up gains, specifically annuity accounts, you could transfer it here and then potentially use that and never have to pay tax on that money. So that's just a planning strategy, an option that's available. Again, you can use just outside of money that's not in anything yet, like just cash savings or investments or something like that to fund this policy. But that would be, if you're in that situation, this could be a really useful thing to consider.
Typically, when we write insurance for people, it's part of a larger plan. I mean, seldom do people just like call us up. I want to talk about long-term care. Which policy do you think I ought to have? We pick a policy for them, we explain it, we sign them up, we sell them, they go on their way, and we hear from them when they need long-term care. That's not the way we work. I mean, we're financial planners. Tom and I are both CFPs. We do financial planning around these 7 areas, and what we've been talking about today is primarily long-term care. But most of the times when we write a policy like this, or this one specifically, it's part of a larger plan. Okay, is we're taking the money out of your investments and moving it into something that's going to pay substantially more for long-term care. We talked a little bit about Medicare today because Medicare doesn't pay for long-term care. That's a misconception that people have. We haven't talked about 401k or IRA. We can't put IRA money directly into this. So we're going to have to pull it out of the IRA before we make a deposit into this. So that may be a stop sign for this particular policy. We talked a bit about income because this is when your family has a gigantic need for income and you still got to pay your other bills when a long-term care event happens to you. The estate planning aspect of this is that there's going to be a lot of people that are going to buy this policy and never use it. They're just going to pass away and never have qualified for anything. Well, then their beneficiaries in their estate is going to get whatever the 100,000 grew to at 3% minus the long-term care charges, and whatever the cash value is at the point of their death, it's going to go directly to their beneficiaries. And then taxes, we've mentioned them that this money paying out of this policy for long-term care is going to come to you tax-free. So I'd like to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.